Warren Buffett, often called the Oracle of Omaha, is a name synonymous with investment success. He maintains a down-to-earth persona. Despite his immense wealth and influence, Buffett's journey from a young boy fascinated by numbers to a financial titan is an inspiring tale. His story is about making smart choices, staying patient, and building for the long term. Known for his sharp wit and commitment to philanthropy, Buffett has pledged to donate the majority of his wealth to charitable causes. His investment philosophy, rooted in value investing, has inspired generations of investors. Buffett's ability to identify undervalued companies and hold them for the long term has been the cornerstone of his success. His story is a testament to the power of patience, discipline, and a long-term perspective in investing. Warren Buffett's track record speaks for itself. His company, Berkshire Hathaway, is a conglomerate with holdings in diverse industries. Beyond his financial achievements, Buffett is known for his philanthropic endeavors. His commitment to giving back is a testament to his character. Buffett's investment philosophy is rooted in value investing. He seeks out companies with strong fundamentals and long-term growth potential. One of Buffett's famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This statement encapsulates his investment strategy perfectly. Understanding Warren Buffett's investment strategies can benefit anyone. His story offers valuable lessons about patience, discipline, and long-term thinking. Buffett's approach is about understanding businesses, their intrinsic value, and their potential for future growth. By examining his early influences and career trajectory, we gain insights into his success. Key principles include value investing, long-term growth, and avoiding market speculation. Through anecdotes, we illustrate how Buffett has applied these principles to build a successful portfolio. His story offers valuable lessons on navigating the financial world and building a successful investment portfolio. Warren Buffett's story begins in Omaha, Nebraska. Born in 1930, he was the only son of Howard and Layla Buffett. His father, a stockbroker and congressman, instilled in him a keen interest in finance. Growing up, Buffett displayed an early aptitude for numbers and making money. Omaha's strong work ethic and traditional values shaped Buffett's character. He was known for his frugality and willingness to work hard. Buffett devoured books on investing, particularly those by Benjamin Graham. These early ventures provided invaluable experience in entrepreneurship. Buffett's entrepreneurial spirit was evident from a young age. At 6, he sold Coca-Cola bottles for a profit, demonstrating his early understanding of supply and demand. As he grew older, his ventures became more ambitious. He started a pinball machine business and later expanded into the used golf ball business. These experiences taught Buffett the importance of finding market needs and providing valuable services. He spent hours reading company reports, studying financial statements, and understanding business success factors. Buffett's entrepreneurial spirit was about problem solving, innovation, and adding value. These early experiences laid the groundwork for his future success. Buffett's father, Howard, played a pivotal role in shaping his early interest in business and investing. Another significant influence was Benjamin Graham, considered the father of value investing. Buffett devoured Graham's books, particularly The Intelligent Investor. In 1950, Buffett attended Columbia Business School, where Graham was a professor. Under Graham's tutelage, Buffett honed his investment skills. Beyond the classroom, Buffett sought out mentors in the business world. He interned at his father's brokerage firm and reached out to successful investors. Buffett was a sponge for knowledge, constantly seeking to expand his understanding of business and investing. Buffett's formal education played a crucial role in shaping his investment approach. After graduating from the University of Nebraska, he enrolled at Columbia Business School. At Columbia, Buffett immersed himself in finance, learning from Benjamin Graham. He excelled in his studies, graduating with a Master of Science in Economics in 1951. Buffett believed that practical experience was equally important. He sought opportunities to apply his knowledge, interning at his father's brokerage firm and working as a securities analyst. These experiences taught Buffett the importance of thorough research and disciplined analysis. This combination of formal education and practical experience laid the foundation for his future success. Armed with a degree from Columbia, Warren Buffett was eager to apply his knowledge. Landing his dream job on Wall Street proved challenging, so he returned to his roots. He took a job as a securities analyst at his father's brokerage firm. Buffett continued to hone his investment skills, developing his own philosophy. In 1956, he launched Buffett Partnership Limited with support from family and friends. Operating out of a small office in Omaha, Buffett focused on finding undervalued companies. Word of his investment acumen spread quickly, attracting eager investors. Buffett's disciplined and value-oriented approach consistently delivered impressive returns. Buffett Partnership adhered to a strict investment philosophy centered on value investing. Buffett sought out undervalued companies with strong fundamentals and solid management. One of his early successes was with Geico, a car insurance company. Buffett recognized Geico's potential for growth and acquired a significant stake. Another notable investment was in American Express during a scandal. Buffett saw an opportunity and invested heavily, acquiring a significant stake at a discount. American Express recovered, and Buffett's investment paid off handsomely. His disciplined approach consistently delivered impressive returns for his investors. In 1962, Buffett's partnership began acquiring shares in Berkshire Hathaway, a struggling textile company. Initially, Buffett's investment was opportunistic, buying a dollar for 50 cents. As he gained control, his vision for Berkshire Hathaway evolved. He saw it as a platform for his investment activities. In 1965, Buffett took control of the company and shifted his focus. He moved away from textile manufacturing and towards insurance and other businesses. The acquisition marked a turning point in Buffett's career. Under his leadership, Berkshire Hathaway evolved into one of the most successful holding companies in the world. Warren Buffett's investment philosophy is deeply rooted in the principles of value investing, a strategy pioneered by his mentor, Benjamin Graham. Value investing is about identifying companies trading for less than their intrinsic value, essentially buying a dollar for 50 cents. Buffett believes the market often misprices companies, creating opportunities for astute investors. Central to value investing is the concept of intrinsic value, representing the true worth of a company. Buffett and other value investors spend countless hours analyzing financial statements and industry trends. This rigorous analysis allows them to identify companies trading at a significant discount. Buffett's approach is about identifying companies with strong businesses, solid management, and a durable competitive advantage. One of Warren Buffett's key principles is investing in companies with a durable competitive advantage, or a moat. Just as a moat protects a castle, a competitive advantage protects a company from competitors. Buffett seeks companies with wide and deep moats, difficult for competitors to replicate. Sources include economies of scale, brand recognition, high switching costs, network effects, and intellectual property. Companies like Coca-Cola and Walmart benefit from economies of scale. Strong brands like Apple and Nike command premium pricing and loyalty. Buffett understands that companies with wide moats are better positioned to generate long-term value for shareholders. Warren Buffett is renowned for his long-term perspective. He believes the stock market transfers wealth from the impatient to the patient. Buffett views stocks as ownership stakes in businesses. He invests with the intention of holding for many years. His patience is evident in his investment track record. For example, he has held Coca-Cola shares since 1988. Buffett rides out market volatility, avoiding rash decisions. His patience and discipline help him outperform the market. Another cornerstone of Warren Buffett's investment philosophy is his belief in investing within his circle of competence. Buffett readily admits that he does not understand every business or industry. Instead of trying to be an expert in everything, he focuses on investing in companies that he understands, those operating in industries he knows well. Buffett believes that having a deep understanding of a company's business model, competitive landscape, and industry dynamics is essential for making informed investment decisions. He is not afraid to pass on investments, even if they appear undervalued, if he does not feel comfortable with the underlying business. This disciplined approach has helped him avoid costly mistakes. and focus his capital on opportunities where he has a competitive edge. Buffett's circle of competence has evolved over time as he has gained experience and knowledge. Early in his career, he focused on investing in companies in industries he was familiar with, such as textiles, insurance, and banking. As he gained more experience, his circle of competence expanded to include consumer goods, energy, and technology. However, even today, Buffett remains true to his principle of investing within his circle of competence. He is not afraid to admit when he does not understand a business and is willing to pass on investment opportunities that fall outside his area of expertise. This disciplined approach has been instrumental in his ability to avoid costly mistakes and generate consistent returns for Berkshire Hathaway shareholders. Warren Buffett's acquisition of Berkshire Hathaway in the 1960s marked a pivotal moment in his career. What began as a struggling textile company transformed into a financial powerhouse under his leadership. Initially, Buffett saw Berkshire Hathaway as an undervalued asset. He recognized that the company's liquidation value exceeded its market price, presenting an opportunity to unlock hidden value. However, as Buffett acquired more shares and gained control, his vision for Berkshire Hathaway evolved. He shifted the company's focus away from its declining textile operations and towards insurance and other businesses with strong earnings potential. Berkshire Hathaway became the investment vehicle through which Buffett would acquire and manage a diverse portfolio of companies. One of the key factors in Berkshire Hathaway's success has been Buffett's decentralized management approach. He believes in empowering the managers of his subsidiary companies, allowing them to run their businesses with a high degree of autonomy. This approach fosters a culture of entrepreneurship and accountability within Berkshire Hathaway's vast network of businesses. Buffett's long-term vision and commitment to value investing are reflected in Berkshire Hathaway's investment portfolio. The company's holdings include a mix of publicly traded stocks and wholly owned subsidiaries, all selected based on their strong fundamentals, durable competitive advantages, and long-term growth potential. Berkshire Hathaway has become synonymous with value investing, and its annual shareholder meetings are legendary gatherings of investors eager to hear Buffett's wisdom. Warren Buffett's investment in Coca-Cola shows his belief in strong brands and durable competitive advantages. In 1988, Buffett began acquiring shares of Coca-Cola, eventually accumulating a significant stake. He recognized Coca-Cola's enduring brand strength, global reach, and consistent profits. Coca-Cola has proven to be one of Berkshire Hathaway's most successful investments. The insurance industry has been crucial to Warren Buffett's success and Berkshire Hathaway's growth. Insurance companies collect premiums upfront and pay claims later, creating a float. This float is invested, generating income to supplement profits. Buffett has leveraged this float to fuel Berkshire Hathaway's expansion. The insurance operations provide a solid foundation for growth. Warren Buffett's investment in American Express in the early 1960s is a classic example of his contrarian approach to investing. In 1963, American Express was embroiled in a scandal involving fraudulent warehouse receipts. The scandal rocked the company, sending its stock price plummeting. However, Buffett saw an opportunity amidst the chaos. He recognized that the scandal did not fundamentally damage American Express's core business. Buffett invested heavily in American Express at a deeply discounted price. His bet on American Express proved to be a wise one. Beyond his significant holdings in companies like Berkshire Hathaway, Coca-Cola, and American Express, Warren Buffett has built a remarkably diverse portfolio across various sectors, reflecting his philosophy of not putting all his eggs in one basket. His investments demonstrate his ability to identify undervalued assets and companies with enduring competitive advantages. Buffett's investments in consumer goods like Kraft Heinz, Procter & Gamble, and Coca-Cola reflect his belief in their stability and profitability. In energy, Buffett has invested in companies like Occidental Petroleum, Chevron, and Berkshire Hathaway Energy, highlighting the sector's long-term importance. His investments in financial institutions like Bank of America, Wells Fargo, and American Express show his understanding of the industry's dynamics. Warren Buffett's influence extends far beyond the balance sheets of Berkshire Hathaway. His commitment to value investing and long-term thinking has had a profound impact. Before Buffett, short-term speculation was more common. Buffett's success challenged this short-sighted approach. He showed that patience and discipline could be more profitable. Investors began to study his methods and philosophy. The rise of index funds can be partly attributed to Buffett's influence. Beyond his investment acumen, Warren Buffett is admired for his ethical business practices and commitment to integrity. He emphasizes honesty, fairness, and transparency in all dealings. His reputation for integrity has earned him the trust of investors and the public. Buffett's approach to corporate governance benefits all shareholders. He advocates for corporate social responsibility and giving back to communities. His philanthropic pledge reflects his commitment to social responsibility. Despite being in his 90s, Warren Buffett remains an influential figure in the business world. His annual letters to Berkshire Hathaway shareholders are eagerly anticipated by investors and business leaders alike, offering insights into his investment philosophy, his views on the economy, and his thoughts on a wide range of topics. Buffett's influence is also felt through his philanthropic work. His decision to donate the majority of his wealth to the Bill and Melinda Gates Foundation has made him one of the most significant philanthropists in history. This act of generosity will have a lasting impact on global health, education, and poverty alleviation efforts. Buffett's legacy is likely to endure for generations to come. His investment principles, his business acumen, and his ethical stance have inspired countless individuals and shaped the way business is conducted around the world. Future generations of investors and business leaders can learn much from studying Warren Buffett's career. His emphasis on long-term thinking, his commitment to ethical behavior, and his ability to identify undervalued assets remain as relevant today as they were decades ago. Buffett's story is a testament to the power of patience, discipline, and integrity in achieving success in business and in life. Warren Buffett's journey from a young boy fascinated by numbers to one of the world's most successful investors offers a wealth of knowledge for anyone. His story is about making informed decisions, focusing on the long term, and adhering to core principles. Buffett's investment philosophy emphasizes thorough research and understanding a company's intrinsic worth. Investing is not about chasing quick profits, but holding investments for the long haul. Patience and discipline are key for building lasting wealth. Buffett's story highlights the importance of investing within our circle of competence. Success is not just about money, but also about integrity and the legacy we leave behind. In a world of instant gratification, Warren Buffett stands as a beacon of patience and discipline. His long-term perspective has been instrumental in his success. Buffett's ability to resist impulsive decisions and weather market fluctuations teaches us that building wealth takes time. There are no shortcuts to success in investing. The greatest rewards come to those who wait. It's about making calculated decisions based on research and resisting the urge to chase short-term gains. This disciplined approach requires patience. Buffett's commitment to patience and discipline serves as an inspiration. True success often comes to those who stay the course. Warren Buffett's impact extends far beyond finance. His philanthropy and ethical business practices have cemented his legacy. Donating most of his wealth to the Gates Foundation is a testament to his belief in giving back. Buffett tackles global health, poverty, education, and climate change. His generosity and empowerment model a more equitable world. True success is measured by the positive impact on others. His words and actions have touched countless lives. His annual letters offer wit, wisdom, and common sense advice. Buffett advocates for ethical business practices and responsible investing. His legacy is about integrity, generosity, and purpose.